Earlier in the week, we talked about Ken McElroy's plan to buy $500 million in multifamily assets over the next 12 months. I knew at the time that I was going to bring up this topic with Jonathan Twombly, somebody who has also purchased lots and lots of multifamily over the years. Jonathan, how you doing?
Good, Michael. I have to say I'm not in Ken McElroy's league, but thanks for thanks for mentioning me in the same breath as him.
Yeah.
So
Well, you're in his league, at least in my opinion. But yeah, maybe with one less zero.
yeah, yeah.
So I want to break down what Ken said because I think it's an interesting plan that he can deploy given who he is. But I want to start with the reality that Jonathan Gray from Blackstone 6 months ago, maybe 4 months ago, directly called the bottom. Then we had Grant Cardone say basically, screw lending, I'm going to pay cash for Class A assets. And now we have Ken McElroy declaring that he is going to buy $500 million in the next 12 months, which I just love that he put that kind of time barrier on there. In your opinion, with these stalwarts, these, tippity top investors, is that a sign that the bottom is at least close for Class A assets?
Well, I mean, let's put it this way: who cares where the actual bottom is, right? Because that's not really a completely irrelevant consideration, right? You're never going to time the bottom perfectly. It's really whether it's a good time to buy or it's not a good time to buy, right? And
Like it.
what I would think of as a good time to buy is when there's less risk of a crash, and there's less risk of a crash after you've already had the crash, right? So what I think that these folks are saying now, maybe, Blackstone sort of called the bottom, directly to kind of,
Mhm.
yeah, get some attention and garner some
I'm
views and what.
sure. I'm sure.
I don't think that they seriously can say this is the bottom, and I don't think that the bottom is in yet personally, because I still think we have this huge backlog of foreclosures in waiting, essentially, right? That are going to come. But it really doesn't matter, right? Because if you, let's just say, the market, I think by consensus is down 25 to 30%. If you're buying at a 25 to 30% discount off the market peak, and the market goes down another 5, 10%, but you have long-term debt, like, what do you care, right? You
Yeah.
don't care
Yeah.
that you didn't time it exactly right. The thing about real estate is, unlike a stock, it's not liquid, right? You can't buy whenever you want to. Like, if you want to buy Apple, you can buy Apple whenever you want to. There is no time that you can't buy it. There's always Apple stock for sale, right? It's not the case with real estate. So I think
Mhm.
with real estate, if Ken McElroy is saying he's going to buy 500 million of Class A, if Grant Cardone is saying he's going to buy all this Class A for cash, what they're thinking about is, now is a good time to buy. I've got to buy when I can, when the deals are available, and so I'm not going to wait until later when I might not be able to find a deal. Yeah, it doesn't matter if the market's down another 10% if I can't get a deal to buy at that
Right.
time. So
No.
that's, I think, what they're doing. They're saying now it's a better time to buy than it was 2 years ago. It's probably, they're making the assessment, it's probably a better time to buy now than it will be 2 years from now. So now's the time to move if they've got the funds and they can find the deals.
Yeah, I think one of the things that's subtle from all three of them, Jonathan Gray, Grant Cardone, and Ken McElroy, is they are directly focused on Class A. And
Yeah.
actually Class A new. Um, Ken McElroy actually talked about potentially buying buildings that are still not completely leased up, right? Because I think what all three of these, top tier investors are seeing is in Class A is the opportunity has never, hasn't been better in decades. They're also seeing a lot of the big players still licking their wounds, right? Ken McElroy was very clear in his call that, he tried to buy stuff the last 2 years and couldn't because a lot of the stupid money overpaid. But now he's licking his chops because all of that money and all that LP money is burned. So it will be harder to raise. And
Yeah.
he has his reputation intact because he never overpaid for anything. He just focused on operations. So his portfolio is running, it's been managed, and he doesn't have any of that baggage to clean up.
Yeah, I mean, I think so. Just addressing like the Class A piece of this, I think that's really astute what they're doing because they know that. So Class A, and in particular in like the Sun Belt, right? It's in an overbuilt, oversupply situation, right? Which means that a lot of those assets are struggling, and they may be able to buy them for an even steeper discount. And they also know that cash is king in this situation, right? Because those assets are not stabilized, your options are going to be either bridge debt or cash, right? Because there's not going to be any bank debt or agency debt available for those assets if they're not stabilized, which means you're going to get a discount. So if you have the cash, and it also means like they know based on demographics and history that those properties will lease up, right?
Oh
It's
yeah,
just so the risk on anything like that is the debt. And if you're not dealing with the debt at all, or if you're buying it at a price where you have a big margin of safety and you're going to cover your debt costs. So let's just say it's like an 80% leased up brand new Class A property. You're not an idiot who's buying it at the value of at least, of a stabilized property and putting debt
right.
on it, right? They're buying it at that depressed price based on the depressed occupancy, based on what's going on in the market with debt that fits that asset. And maybe that's going to be, when the whole thing is fully leased up, 50% LTV or less. But it
Exactly.
doesn't, it
Probably
doesn't,
less. Yeah,
it doesn't matter, right?
I
Because
agree.
they're thinking long term. They're thinking about striking while they're able to get real value on these assets. When other people can't buy them, the buyer pool is limited, right? And they've got the cash and the ability to move. And it's a really smart play as far as I'm
No,
concerned.
I agree. I think all three of these gentlemen are showing us really how to build legacy wealth. I mean, in Ken McElroy's discussion, he talked about being a speedboat around cruise ships or battleships. I forget, big ships.
Mhm.
Basically saying all this other money on the sidelines will eventually swoop in after they deal with whatever they have. And he's like, dude, I got to strike now. I got a 12-month window before these individuals who have deeper pockets come in. So that's really cool. The other thing I thought was really, really interesting in Ken McElroy's discussion is he's looking at this next 12 months as an opportunity to make his portfolio younger,
Oh
right?
yeah.
When he talked about his portfolio today, he has, a lot of 80s products that when he bought them, they were 20 years old. Now they're 40, 45 years old. And he's like, you know, his plan essentially, reading the tea leaves ever so slightly is he's going to sell some of his older product 1031 into newer products. So that's genius, right? If you can go in and get all of that equity spread that you've gained over the years, take that tax free into a bigger asset at a depressed price. That's essentially what I did on a much, much, much smaller scale. Take a house, buy an apartment, houses crazy, apartments depressed. It's a great strategy. I think he's going to execute.
This is exactly what I saw people doing after the last crash. People had been in the business, they'd held their assets a long time. They were, largely depreciated on those assets, and
Yep.
those assets were older, and they sold off those assets at the quote unquote bottom of the market because they wanted to free up cash. They weren't,
Yep.
they were not greedy on those deals that they had. They were greedy on the deals they were going to buy. Right. And,
Exactly.
and to do, and so I've talked extensively about 1031 and the way that it is used properly as opposed to the way that it's used stupidly. Now, the stupid way to use 1031 is like you're greedy, you sell at the top of the market, and then you're like, rather than just paying the tax and putting the cash in your pocket, you go and you reinvest it at the top of the market into like whatever deal you can possibly find, and then you're on the
Yeah.
ride down, right? So
Yep.
you've levered up to the
Agreed.
hilt, and now you're like, and I'm seeing this happen. I'm seeing people who were like, you know, they were greedy at the top. They sold, they went into 1031, they bragged about all the money they made. And now, you know what? They're going to lose not only the gain they made, they're going to lose the original equity because they're getting
Yep.
foreclosed on, right? Because they were, and I said at the time, people should not be doing this,
I
and they did
know.
it anyway, right?
No, I
I mean, they weren't
totally
going to
agree.
listen to me. They weren't going to listen to me. But I mean, what I'm saying is
Yeah.
like, I warned that this was the scenario, and people were telling me, oh, you can't have cash uninvested. Oh, you should never pay the tax. Oh, you should.
Ugh.
Oh, this is Jonathan, you're an idiot. And I was like, look, this is what happens. You buy at the top of the market, you lose plus you don't have the cash available to buy bargains. Now, the
I
smart people like Ken
totally
McElroy,
agree. Mhm.
smart people like Ken McElroy just wrote it out, right? And now they're selling these assets, and he's like, you know what his attitude is? Am I making as much money as I possibly could on these assets? No. Am I making enough money? Yes. And what am I going to do with that money? I'm going to turn it around. I'm going to exit all these old properties. I'm going to put it into the brand spanking new best properties that are out there
Exactly.
that are going to be hassle free for the next 10 years. And that's just such a
It's
smart thing for him to
genius.
do.
It's genius. It is absolutely genius. And again, I totally agree with you. I've seen so many people exit into a 1031 at the top of the market because the asset they owned they felt was overpriced, not realizing that they're buying into an overpriced market as
Right.
well.
They think like, oh, we're going to get out of this one. We're lucky, but somehow the
Yeah.
one they're buying is immune to the same market forces. Right.
Yeah.
And really, if you're lucky enough to cash in at the top, and I would say this to people all the time, you're going to, people are like, oh no, we're going to have to pay like whatever it is, capital gains tax of
Hmm.
20% or whatever. And it's only on the gain, mind you, right? It's not on the
Hmm.
whole chunk of money you're getting out. Right. Like, so
Yeah.
if you sell at the top and you pay 20% in capital gains tax, and then the market falls by 30%, you're better off by 10%, right?
Yeah, exactly.
And if you buy at the top and then you lose everything because like you have to stay invested, it's cash is trash, right? It's the same thing. Like people were like, oh, we have inflation. It's like, well, yeah, but if you think about,
Yeah.
and people used to make this argument when inflation was 2%, oh, you have to stay invested. And I'm like, it would take you 10, if there's a market crash and it's 25%, correction, right? And
Hmm.
you have to wait 10 years for that to happen, you're still up by 5%, 2% inflation a year, right? I mean, you're still up by 5%, having that cash in the bank is collecting zero interest. That's why like all that dry powder on the side, supposedly people are like, oh, it's going to swoop in. Oh, they're losing to inflation. Oh, they're stupid. No,
Oh,
they're doing the math. And they're like, if I'm going to buy for 50 cents on the dollar, yeah, I can ride out 2% inflation for 25 years, right?
absolutely right.
Yeah.
Absolutely right. So the other thing that I took away from Ken McElroy is while Class A is the opportunity and Jonathan Grant and him are taking advantage, they're very clear that Class B and Class C have not even started yet. He's like, the pain coming there is um, on order magnitude of the Great Recession, but it hasn't started. So I thought that was really interesting. Class A is where stuff is transacting. They're making their moves now because they have a small window. But he's like Class B and Class C, not even started yet. The pain is large, the pain is big. And he gave some numbers. He talked about Phoenix, his area. At the peak of the market, which from memory was I think he said it was March or April of 21. He said you were seeing Class B assets in Phoenix trade for over 310,000 a door. They estimate today that the value is 190 a door, best case.
Wow.
So, and he's like, that stuff's not transacting yet. So he's like, the pain is going to be large. A lot of LPs are gone. I mean, you just do the math. That's like a 35% haircut.
Oh yeah.
Um, and it's just starting, right? Wait till
Well,
that
not
stuff actually starts showing up.
yeah, but not just as a 35% haircut, but 100% of the haircut is coming out of the equity.
Equity gone.
Right. Yeah. Right. And then maybe even some of it's coming out of the debt too.
A
And
little bit, yeah.
I'll tell you, I mean, some scuttlebutt that I've heard is, you and I were talking at the time about all this bridge debt. Everybody was doing bridge debt at the top of the market, right? They were in place of permanent debt. It was all floating rate. It was all very, very low DSCRs, very high leverage. And there are bridge lenders, these bridge lenders who thought they were so smart stepping in when the banks wouldn't step in. All of their loans are underwater.
Oh,
All of them. Entire portfolios of loans are now the properties are worth less than the
the
loan on
debt.
the property.
That's
I,
not good.
yeah, entire portfolios, like every loan they made, right? Because they did it all at the top because they were such geniuses. And they're look at the banks missing this opportunity. We're going to
Yeah.
step in. Just that's what greed does, right? So uh, it's going to be interesting to see what happens with
Well, let's talk
those.
about that. I mean, some of
Yeah.
these bridge lenders, they're just basically portfolios of loans. And if they're all underwater, A, the equity's gone. So that's a reality. How do they get out of that? Do they sell and just take losses? Do they kind of hold and try to take an equity position as another operator takes over? I mean, how do you think they get through something like that? Because that's painful.
Yeah, I don't know. I mean, if they foreclose and sell, they're all going to be selling for less than the value of the loans they have on the property, right?
Yeah, probably
So
significantly. Yep.
maybe they suddenly turn themselves into, they take these their hope, and you have to remember all of these people have their own LPs, right?
Right.
Who all invested
On
into
a
these.
clock. There's on a clock. Yeah.
Right. All they have their own LPs who are all investing into these, debt funds. And so what I think may happen to a lot of them is that they're going to turn into equity holders because they've got no choice, right? If they sell, they're selling at a huge loss, right? So that they may be thinking, okay, we're just going to step in. We're going to
Mhm.
figure out how to run these, we'll turn ourselves
A
into equity
little prop.
shops, and
Yeah.
we're just going to hold them for 10 years until we're back in the money again, or
But
whatever
they
it is.
gotta foreclose, right? They've actually got to take the asset back.
I think in a lot of cases they're going to, and they're just going to have no choice,
I
right?
agree.
Either
That's
that, or
how,
they
yeah. Yeah.
either that, or they just like try to, well, stick with the current operator
I
and
I
say we
cannot
just make
imagine.
10%.
I actually think all of them get foreclosed. I can't imagine being an LP in that fund that doesn't force the operator to take it back. And yeah, you're going to become an operation firm for 3 years or
Well,
5 years.
I think it really depends. Like as we've said before on this channel, I think it's going to be there's going to be a case by case analysis, right? I think they're going to look
Yeah.
at who the
I don't
operators
think
are.
any of the solid operators were getting bridge debt at the peak. It was all
Uh,
stupid newbies.
I
No?
don't, not just, no, it's
Okay.
not. I mean,
All right.
there were a lot of people who were, because it was too easy to raise capital.
Mm,
I mean, people just, it's greedy. I mean, it's funny, like if you ever read the book, Irrational Exuberance,
I
right?
have. Yep.
One of the things that he talks about is that the experts were no better than the retail investors at figuring out what was going on. They all made exactly the same mistakes. So when people were pointing in at Wall Street and saying, well, look, Wall Street's investing in this stuff, so should we, because look how smart
Mhm.
they are.
Yeah.
They just all made the same
Group
cognitive
group think.
errors.
Group
Yeah.
think. Yep.
So you see the same thing in the real estate market now. I mean, all those guys who started those debt funds, they're all like super smart financial geniuses, right? I mean, these guys, I mean, right? A lot of them were
Yeah.
just like
Yeah. They got
MBAs,
fancy
and
degrees. Yeah.
yeah, so they supposedly had like superior knowledge to everybody, but obviously they didn't. I just want
Dude,
to bring up, so I
well,
I
one more
just
thing. One more thing. Real estate, as you and I have learned over 20 years, is momentum. And momentum, as it gets going, really leads to stupid decisions. That's what I think a lot of people don't realize is the momentum eventually stops.
Well, I mean, I sometime maybe I should revive this for this channel, but I used to do this presentation on market psychology with a cycle, right?
I
You use the
remember,
word
yeah.
cycle, right? And so, and talking about how people pile in at the top because it takes time for them to like, because most people's investment research consists of looking around and seeing what other people are doing or hearing what other
Exactly.
people are doing, right? And so when you've got your friends telling you like, look at all this money that I made in real estate, you got to do it too, and they all pile in, they don't realize it. It's like the people who got in earlier are the ones who make the money, and the people who got in, but nobody ever thinks they're late, right? They always
Hmm.
think like
Hmm.
they worry about missing out, but they don't really think like, oh, I'm the guy who's investing at the top. I'm the greatest fool, right? People psychologically can't do that. So
Right.
you just see the same cycle, the same psychology happen each time. Speaking of which, somebody posted a really great graph today on LinkedIn where they compared the 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 Federal Reserve's apartment price index to Google searches for passive income, and they track exactly. The curve is exactly the same. It's
How
amazing. It's like
funny.
it's so well correlated, right? So people were all jumping into the apartment space as the market went up. But I wanted to make one sort of last anecdotal point. So one of my students came to me the other day. She's like, "Hey, I found this deal. I've tried to underwrite it. I want you to check my underwriting." And so we were looking at this deal together, and it's a deal in Florida, and purchased sold in 2018. Sorry, purchased in 2018 for 10.8 million dollars, right?
Hmm.
Then sold in 2022 for $20 million, right? So basically they
A double.
5x, not,
Yeah.
well, yeah, but the equity was
Well,
5x,
yeah, the equity was
right?
5x. Yeah.
The equity
Yeah.
was 5x on this property. Apparently if they did a value add, they didn't do much because the 2022 buyer bought it as a value add, as one
Of
did
course
in
they
those
did.
days,
Yeah.
right?
Yeah.
Now, so we were looking at, they didn't finish the value add, right? Obviously, like, they couldn't get it done. Um, and the building is now 80% occupied. And, I was looking at the numbers, and so the debt on it is $15 million, right? It was 75% LTV at the time of purchase.
Mhm.
Again, a bridge lender who did the loan on the thing.
Yep.
So we underwrote it, and I said, look, fully stable, if you were to be fully stabilized and occupied at the higher rents that you believe you can achieve after your value add on this property, the
Mhm.
property at that state is worth $17 million, right? So it's worth 3 million less than what it was,
Yep.
paid for 3 years ago. That's
Mhm.
assuming that you're like stabilized and everything. But in its current state, it's probably worth about $13 million, right?
Right.
And so, and that's a deal that was bought for $20 million just 2 years ago.
Yeah.
And I think,
Yeah.
this is
You
this
know what I would
pattern.
do with a deal with like that? I'd write it for 10 million bucks. I'd
Oh yeah,
force them to,
yeah,
that's what I would do.
yeah. I said, listen, I mean, yeah, exactly. And if even
And
less
then
than
just
that,
follow up, then follow. Yeah, exactly. Maybe even less than
yeah,
that, maybe 9. Yeah. And then just
yeah,
follow. That's the deal, right? New investors or investors in general, we're not Ken McElroy. We're not Grant Cardone and we're not Jonathan Gray. We only need one.
yeah,
We need one. So write disrespectful offers. That's the key to all of this.
yeah, exactly. And just, I mean, but what I wanted to say is that if you think about that particular deal, like,
Yeah.
that bridge lender, they did that deal in
Yeah.
2022, like 20, 30, 40 times, right?
Exactly.
And all of those deals look the
Totally agree.
same. Even if they're fully stabilized, they're worth,
Less than
pretty
the
much all the equity is wiped out, right? And if they try to refinance, that's a cash in refi, right?
big time. Big
So
time.
it's just, I mean,
Yeah.
this pain is still working its way through the system.
This I'm so glad you and I have receipts, and I still remember that video where we turned a $100 million building into 48 million with just minor tweaks because it's happening in real time. Jonathan, where can people find you?
Yeah. So come and follow me on LinkedIn. That's where I'm really active these days. Also, if you want to join my coaching community, come to SKOOL.com and look for Apartment Investors Club, and you can sign up. It's very reasonable, and you can get direct access to me and all my materials that way.
Awesome. Thank you so much.